Over 2 days in late March 2021, the world's biggest banks began quietly dumping billions of dollars of stock. Huge blocks of a media company, a Discovery Channel, a handful of Chinese tech names, all at once, all for the same reason. A single New York firm most people had never heard of had failed to make a margin call. It was called Archegos. It managed the personal fortune of one man, and at its peak it controlled positions worth more than $36 billion using money that was mostly borrowed. When the selling stopped, roughly $10 billion had been wiped from the balance sheets of global banks, and one of the fastest-built fortunes in Wall Street history was simply gone. What the U.S. Justice Department would later call it was not bad luck. It was a scheme. The man at the center was Bill Hwang, known to almost everyone as Bill. He had learned the trade under Julian Robertson at the legendary hedge fund Tiger Management, one of the so-called Tiger Cubs, who went on to run their own funds. His own firm, Tiger Asia, was successful for years, but in 2012 it collapsed under a legal cloud. Tiger Asia pleaded guilty to a count of wire fraud tied to insider trading in Chinese bank stocks, and Hwang and his firms paid $44 million to settle related civil charges with the Securities and Exchange Commission. Barred for a time from managing other people's money, Hwang did something that would prove important. He converted his operation into a family office. A family office invests only the wealth of its owner. Because it manages no outside clients, it faces far lighter disclosure and registration requirements than a normal hedge fund. He named the new firm Archegos, a Greek word meaning roughly a leader or one who goes before. It was, on paper, a quiet private office. In practice, according to prosecutors, it would become one of the largest hidden forces in the American stock market. To understand how a private office moved $36 billion, you have to understand who lent it the muscle. Archegos traded through the prime brokerage arms of the biggest banks on Wall Street, firms like Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, and UBS. Prime brokers exist to finance big investors. They extend credit, process trades, and take collateral in return. Each bank could see its own slice of Archegos. What almost none of them could see, according to the government's case, was the whole. The instrument that made Archegos invisible was something called a total return swap. Here is the idea, stripped down. Normally, if you want exposure to a stock, you buy the shares. You own them. Past a threshold, you have to disclose that you own them. A total return swap is different. Instead of buying the stock, you make a contract with a bank. The bank buys and holds the shares, and you agree to receive whatever gains or pay whatever losses the stock produces. Economically, you get the ride. But on paper, the bank is the owner of record. For Hwang, according to the Justice Department, that arrangement had two powerful effects. First, it let him control enormous positions without ever crossing the public disclosure thresholds that would have revealed how much of a company he effectively held. And second, it let him do it with leverage, putting up only a fraction of the position's value as collateral and borrowing the rest from the bank. A relatively small pile of cash could command a very large bet. Spread across several banks, none of which saw the other's books, that leverage compounded into something enormous and unseen. But hidden size was only half of what prosecutors described. The other half was manipulation. By late 2020, according to the government, Hwang had stopped behaving like the patient, fundamentals-driven investor he claimed to be, and had begun trading to move prices themselves. Prosecutors said he concentrated Archegos Capital into a handful of stocks, among them Viacom, CBS, and Discovery, and then traded in ways designed to push those prices up, buying in size, timing purchases to particular moments, and, at times, marking up the price of a stock at the close of trading to trigger favorable payouts. It was, the Justice Department alleged, a machine for inflating the value of his own book. That manipulation had a second job. It fed the lie he was telling the banks. As Archegos' positions swelled, the banks grew nervous and began to cap how much more he could trade. So, according to prosecutors, Hwang and his chief financial officer, Patrick Halligan, and others gave the banks false and misleading information about what Archegos actually held, understating how concentrated the portfolio was and how much of the same few stocks sat at rival banks. The deception was what kept the credit flowing. Each bank, believing it was one of many careful lenders, kept extending Hwang more rope, unaware of how much rope the others had already handed out. A scheme built on ever-rising prices has one fatal weakness: it needs the prices to keep rising. As long as Archegos' core stocks climbed, the collateral held, the banks stayed calm, and the machine kept running. The danger was any event large enough to knock those inflated prices down, because Hwang's positions were so concentrated that a fall in a single name could cascade through the whole portfolio. That event came in March 2021. On March 22nd, Viacom CBS, one of Archegos' largest and most manipulated positions, announced a large new stock offering, a move that put downward pressure on its share price. According to the Justice Department, Hwang responded on March 23rd by directing nearly $1 billion in additional purchases, a last effort to hold the price up. On March 24th, he tried once more with whatever cash and capacity remained. It failed. The price fell anyway. When Viacom, CBS, and the other names dropped, the value of Archegos' collateral collapsed with them, and the banks issued margin calls, demands for more cash to back the trades. Archegos could not pay. What followed was a race. The prime brokers understood that whoever sold Hwang's positions first would lose the least, and whoever sold last would be crushed. Some banks, reportedly including Goldman Sachs and Morgan Stanley, moved fast and unloaded billions in blocks. Others were slower. Over roughly 2 days, banks liquidated tens of billions of dollars in stock, and the concentrated positions Hwang had spent months inflating unwound in public. All at once, the damage was severe and lopsided. All told, the collapse cost the banks around $10 billion. The heaviest single loss fell on Credit Suisse, which reported a hit of roughly $5.5 billion, a blow that battered the Swiss bank's reputation and, by many accounts, contributed to the crisis of confidence that ended in its 2023 takeover by rival UBS. Japan's Nomura absorbed close to $3 billion. Beyond the banks, the sudden fire sale erased tens of billions in market value from the portfolio companies themselves, losses that fell on ordinary shareholders who had no idea any of this was happening. In April 2022, federal prosecutors in Manhattan charged 4 people connected to Archegos. Hwang and his CFO, Patrick Halligan, were accused of racketeering conspiracy, securities fraud, and related crimes. 2 others, Archegos' head trader, William Tomita, and its chief risk officer, Scott Becker, pleaded guilty and agreed to cooperate. At the 9-week trial in 2024, they became the government's key witnesses, describing from the inside how the banks were misled and how the trading worked. Both were later spared prison for their cooperation. In July 2024, a jury convicted Bill Hwang on 10 counts, including racketeering conspiracy, securities fraud, market manipulation, and wire fraud. Patrick Halligan was convicted of racketeering conspiracy, securities fraud, and wire fraud. In November 2024, a federal judge sentenced Hwang to 18 years in prison and ordered him to pay more than $9 billion in restitution. The Justice Department announced the sentence that December. In January 2025, Halligan was sentenced to 8 years, but the story is not fully closed. As of August 2026, Hwang is appealing his conviction, and he remains free on bail while that appeal is pending. No appeals court has ruled. Separately, he has asked for a presidential pardon, a petition that, as of this recording, is unresolved. And a parallel civil case brought by the Securities and Exchange Commission has not reached a final judgment. The two sides have been in settlement discussions. In other words, the jury has spoken, but the final chapter, on appeal, on clemency, and on the civil side, has not yet been written. Archegos is often told as a story about one man's greed, and it is partly that. But the more uncomfortable lesson is about visibility. A single investor built a $36 billion footprint in the American stock market, and the system's own rules helped keep it hidden. A family office that owed little disclosure, and swap contracts that let real ownership sit quietly on a bank's books instead of his own. Each prime broker managed what it could see. None of them could see the whole animal until it was already falling. Regulators had warned for years that leverage and derivatives could hide risk in exactly this way. Archegos was that warning arriving in the form of a bill, and it landed hardest on shareholders who never placed a single one of these bets. Bill Hwang has been convicted and sentenced. But his appeal is still pending. His pardon request is unresolved, and the civil case has not reached its end. So, the record here is real, but not yet final. If you want to see where risk is really hiding in a market, don't only watch what people own, watch what they've promised to pay for. If this kind of investigation is why you're here, subscribe. Next time, we follow a different paper trail. Until then, follow the money.